What's going on? Welcome to my channel. I am the covered call guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income. I am currently holding 6 cover call ETFs. I do a portfolio review at the end of every month, showing my current holdings, my buys, my sells, and pretty much my year-to-date performance. My annual dividend income right now is $70,000. Monthly is 5.8, weekly is 1.3, daily is $191, hourly 7.99. So hopefully end of the month it goes up a little bit, right? So again, these are distributions, so they vary. I understand that. And if you're new to the income investing and you're trying to reach a certain goal, perhaps the same goal I have, understand that distribution is different from dividends. All right, legal disclaimer before we start. This content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube and I could be completely wrong. All right, with that out the way, today's video, I was hopefully no information changed too quickly. I was just about to put it out and then I had to make some tweaks to it because again, this video is about geopolitical tension happening right now currently in the Middle East, the United States, and yeah, so let's get started. All right, so today's video is going to be on a 2026 macro, where this is the storm. This is the biggest thing that's happening right now, right? The trade recess with the tariffs and the Supreme Court decision, the Kinetic war that's happening, and then the energy shock that could, eventually be the aftermath of this, and the policy chaos, right? So holy moly, we're no longer predicting. It has happened, right? U.S. Israel just attacked Iran, and retaliatory missiles has just hit. They're flying over the place. So here's how it could impact our cover call strategy or my portfolio, right? Just pretty much emergency update on what's happening. The game has shifted. We're no longer at a more outlined 2026. A lot of things are currently changing. So just a quick look on how it affects our cover call holdings, or my hold. I'm gonna be talking about my holdings, but again, I guess a lot of you kind of hold the same thing I do. All right, so let's look at the 3 colliding forces. One is the trade upheaval, right? The U.S. Supreme Court officially invalidated key Trump-era tariffs, right? So this could radically alter inflation dynamics and potentially introduce massive fiscal exposure. And 2, war is officially here, right? The near-term risk is now reality. We're looking at kinetic strikes that have been exchanged, right? Primary arteries of global energies might now be actually directly in the crosshairs, especially the Straits of Hormuz, where a lot of oil pretty much flows through, right? And then look at stagnation activator, right? So with these missiles flying, right, our fragile disinflation trend could be dead. Why? Energy shocks, right, might actually materialize. We don't know how the market's going to react, but I'm going to assume it's not going to be good. It's not going to be great. It's not going to be lovely, right? So a lot of these things could affect our holdings. It could be good, it could be bad, right? Again, if we're holding great holdings, this is good for us because then we buy for the low. So if it drops and it crashes a lot, I'm buying. As much as I want to have a nice fat cash positions, this is what our dry powder is used for. All right, so the question we ask is, why might we survive this chaos? Because war equals volatility, and volatility could mean massive premium income for my holdings like SPY, QQI, and IWMI holdings, right? Our macro economic thesis is playing out. Structural forces might collide completely, but this is where you go, okay, I'm holding great holdings. This is where I can buy the low. This is how generational wealth is built, right? The market might panic. I don't know. Again, it might just be this week, and then the next week might be good, or it might be bad the entire 3-6 months, the entire year. Who knows, right? But we're looking at the financial markets that has pretty much spent 2026 underpricing the speed of geopolitical escalation, and we're seeing it now. I'm pretty sure the VIX is going to spike, right? We have a lot of AI-linked mega cap stock could get aggressively dumped by big institutions seeking safety, right? Standard valuation metrics and linear growth forecasts might just be completely thrown out the window now. We don't know what could really explode from this conflict. But I gotta remember, I hold GPIX, I hold GPIQ, and QDevo, right, to weather this. This is exactly why I hold these holdings, right? If the VIX spikes, these funds are positioned to collect massive cash from selling the option, right? So bottom line here is, while the market bleeds, our cover call ETFs are designed to farm higher premiums. Yes, the NAV may go down, but you're holding quality holdings. You're holding index-based holdings. This is where you can also buy the dip. This is great. We love this. All right, just talking about the Supreme Court, killing the tariffs. What does it mean? It just means the timing is kind of catastrophic for the U.S. budget, because then that means a lot of refunds can happen, right? I think it was like almost 150 to like 200 billion, right? So this legal chaos creates a whipsaw effect, right? This is the exact environment my GPIX and GPIQ ETFs aim to farm their premium income in, okay? Can the president fund a war with illegal tariffs? Of course, the Supreme Court says no. All right, let's look at the $160 billion shock that was collected illegally. Of course, I think Costco is suing right now for its refund and collecting it back, but we don't know what's going to happen yet. Let's just look at worst case scenario. All right, this could seriously hurt the broader S&P 500. Of course, right? The market doesn't like that. It has to kind of give back all this money. It's happy when it collects a whole bunch of money, because it's better for the GDP, right? But this is also why I hold SPY and GPIX instead of the raw S&P 500, right? A potential massive fiscal shock might hit the bond market exactly as war breaks out. At the same time, this is happening. But fear creates great premiums, and this is where we're like licking our fingers. The premiums. Hopefully, that's the way the VIX should play out. Of course, I'm talking about the past scenarios. What ifs? Again, past performance does not imply that future performance will act the same way. All right, let's look at the 150-day tariff loophole. So as soon as the ruling came out, President Trump just signed a proclamation utilizing the Section 1222, basically just imposing a standard 10% global tariff or 15%. It was literally effective the 24th, right? Right as the ruling came out. But he said, okay, so you're going to make me say this tariffs are illegal. I'm just going to use whatever legal power I have to cap it at 150 days, right? So this gives the uncertainty. So uncertainty often equals market chop, right? And market chop can be the perfect environment for cover call incomes holdings such as GPIQ, QDevo, right? And I hold these too. So, okay, you know what? It doesn't affect me that much. I'm okay with market chop. Market chop is actually the best environment for us cover call ETF investors, right? So we're capitalizing on short-term tariffs and short-term pain. Right, this is the big part, right? This is where, okay, this is a possible World War III watch, right? When they're launching all these missiles, kinetic strikes. It has begun. Again, with the making of this video, again, I don't know what could have really changed. The recording of this video, the uploading of this video, I don't know. A lot of ceasefire, a peace deal, I don't know what could have changed. But as of right now, the U.S. and Israel has officially launched strikes against Iranian targets. Iran immediately responded, sending missiles back across all U.S. bases. Pretty much back and forth, we don't know. But as the Nasdaq and Russell 2000 face potential gap downs and sheer panics, this is where my QQI and IWMI ETFs are positions to sell high-priced options, right? We're selling the fear. And if it goes down enough, I'm going to, again, buy the dip, right? Guys, not a dip. State-on-state warfare in the Middle East is actively underway. Prepare for yourself. Prepare your portfolio. Hopefully, you have been listening and stacking away some dry powder for this type of event. Okay? Why? Simply because the ultimatum failed. I think President Trump gave Iran like a 10 or 15 day, right? They're talking in Geneva, right? The warning signs were like, hey, Iran, please do this. They refused, and basically preemptive strikes, right? So implied volatility could go parabolic. This is why I love holding, SPY, QDevo funds, right? They're built to capture these potentially high, historically high premium events as it unfolds. Of course, war is bad. I'm not advocating for it. I should have said that earlier in the beginning. I don't want war. War is bad, right? Innocent lives are lost. But this is the real world, and I gotta talk about real world events and how it could affect us and our money. Okay, and this could lead, of course, to the energy shock, right? So this, I'm talking about the Strait of Hormuz handles roughly 20% of global oil consumption. So with these missiles flying, right, Brett could hit $150, right? The board market might tank. And this is why I said hold cash, hold cash. Cash is not trash, cash is king. And it will always be king, especially if you have, you know, a good patience to just hold yourself and willing to wait for certain events like this happening, right? So we're past the point of maritime harassment. No longer that. We are now entering the high risk and escalating risk. This is where I could see like severe bottlenecks, war risk insurance might spike 2 to 400%. And of course, escalating risk is probably, we're probably past the high risk. We're probably at the escalating risk, right? Where acute supply deficit and inflationary impulses, recession risk, right? And of course, and if it continues on, it's the extended conflicts. This is where we have to watch really, really closely, because this would be permanent infrastructure destruction, and it could really spread and start dragging other countries in, right? So, so if the Brent does hit $150, this is where I'm kind of depending on my 6 cover call ETFs to act as a shock absorber, kind of just collect the premiums. The NAV does drop, but I'm like, okay, at least we're getting paid for this, and we can reinvest to buy the dip. Right, so hopefully you guys are buying a dip. Don't panic sell. All right, stagflation might be reality from this. Of course, we're talking about the U.S. Quarter and the GPT growth slowing down and inflation going up. That's a terrible combo, and then this leads to the Fed's dilemma, right? Rate cuts could be paused, which I think it was paused, and then in fact they might actually have to raise it, right? Stagflation will destroy raw tech growth, right? This is why QQI, GPIQ, and QDIVO ETFs aim to give me tech exposure while paying me the cash dividend to offset the pain. So for those who are holding pure growth, this is where, ouch, this will really hurt you, right? Because central banks are trapped between killing the growth or fueling rapid wartime inflation. So you can't do both. You have to pick one. Most likely, they're going to be pressured to fuel the rapid wartime inflation. All right, S&P 500 price for perfection. This is my scenario. This is how I think is going to play out, right? Looking at a, despite the robust quarter 425, blended earnings hitting about a growth of 13.2%. Looking at the broader index, pretty much trade and uncomfortably elevated forward PE of 21.5, right? I do think the market is priced for perfection of pretty much getting slaughtered by war if this really escalates. I'm relying heavily on SPY and GPIX because of the potential massive compression from supply shocks, which could trigger rapid valuation downgrades. I'm depending on the fear to pay the premium so I can offset the NAV drawdowns. Our portfolios could go like, I don't know, it might drop higher than when a global tariff happened in April. So this really could be where you have to look at your core holdings, be like, oh, which one do I want to average down into? I have 3. I talked about that in my previous video. SPY, QQI, and IWMI will be my main. I'm going to be looking just which one is going to be having the larger drawdowns. I think it's going to be the Russell 2000. So that's going to be the one where I'm going to be, okay, I'm aiming to build up that position. So just looking at your scenarios, right? If you're holding a lot of, what sector you're holding: infotech, financial, healthcare, industrials, energy, right? And then consumer, discretionary, whatever, consumer spending. So that depends on what type of index weight you're holding. If you're holding, not in a single holding, sorry, right? But pretty much I'm holding index space, so I'm just gonna be looking at, okay, which actual sector, right? SPY, the Qs, or Russell 2000. Right, global winners and losers. Again, this is what I think would really be the winners and losers. The United States, I'm gonna say, is the most structurally insulated due to domestic energy independence, but could be acutely exposed to self-inflicted domestic policy. Right, Europe and China, EU could be highly vulnerable due to a lot of the LNG reliance. Right, China does rely on Iran for pretty much a lot of the Middle Eastern oil. So this could really be hurting Europe and China, right? Because if Iran gets removed, China would have to go into Europe, and then that just pushes prices up. And then of course emerging markets, right? We're looking at the future, right? A weakening dollar does drive emerging markets outperformance, but an oil shock might trigger the opposite, right? Violent capital outflows. So looking at my portfolio does heavily focus on US focus and US based. So, you know, could be a good thing as I do think the US is the most insulated market environment out of the three. All right, talking about BRICS and chess. Right, when we're looking about BRICS, we're looking at India, China, Brazil, I think Russia, and then a whole bunch of other countries did join. Now I asked myself here, could I add IDVO? Could it be a good play here? I think yes, right? IDVO from Amplified International Enhanced Dividend Income ETFs. Remember I said, yes, I'm focusing on just 3. But if the IDVO does end up being a very good play here, I will have to start chipping away and adding it as my 7th holding. And my break in my 2026 strategy, yes, but when opportunity arises, you have to take it and you have to snatch it. And I'm looking at IDVO because it does fit perfectly. If is at a good price, it gives me exposure to international markets to hedge against possible US chaos, right? So the West might be playing short-term politics while BRICS secure the next decade, and I want to be playing the next decade, and I think IDVO would be a good play here. All right, let's look at the great growth divide. If you notice something, my entire portfolio is missing from this growth list, right? My holdings are purely US based, right? Because Western growth might be slowing. I do rely on cover calls to manufacture yield, but this chart shows exactly why, right? Having a cash reserve might need to hunt for international deals next, which is why I talk about IDVO, right? Why you might want to buy emerging markets, even if emerging markets does have a weakness, right? It is new. It's pretty much the baby. So as an investor, reacting to this geopolitical shift might require looking beyond U.S. borders, which you should always, right? Emerging markets account for over 40% of global nominal GDP, and that is a lot of money, right? Looking at U.S. cover call plays for these emerging markets, it's IDVO and JPIE, JPI, if you want the other one, right? Why? Earning acceleration, right? 4 to 5 countries comprising 80% of MSCI emerging market index are projected to see double-digit profit growth just this year alone. And of course, the AI supply dominance, right? The structural growth of AI, as long as people are going to talk about the AI bubble, I think AI is going to continue to push on forward. We're too reliant on it now, right? Looking at the Asian supply chain, right? Chinese internet giants developing competitive AI models. We want to all get in on that. And then policy tailwinds, right? We don't know what the current administration is going to do. It's too flip-floppy. You want to have exposure to other markets because, again, policy changes on a dime depending on how an administration feels that day. Okay, my playbook just accelerated. Phase 1 is already happening now. That is the crash and containment. The timeline for me has shifted, right? As the VIX potentially hits 40 plus, meaning the premiums income from SPY, QQI, and GPIX could skyrocket. I plan to collect the cash while the market burns, and if it burns big enough, I will deploy the cash. Phase 2 is the aftermath, right? Looking at the energy shock pricing. Okay, we will have to wait and see if the Strait of Hormuz closes. If it does, you will see gas prices shoot to the moon. You will. It has happened in the past, right? Market will digest the damages. This is where your cash fortress might grow from massive cover call distribution. This is where you could go, I'm deploying my cash too. Phase 3 is the bottom, right? This is where you really want to deploy most, if not all of it. This is what we call generational buying. If blood is in the streets, I plan to deploy my massive cash reserve to load up on QDIVO, GPIQ, and IWMI at generationally low valuations. Of course, we're hoping no nukes go off, because if it does, then everything is useless, all right? So I'm looking at late May, the risk phase could pretty much pull forward to today, stick to the plan, right? I was looking at it in a 9-month time frame. Now I'm looking at a 3 to 6 month time frame. So everything has just accelerated because missiles started flying, and obviously no deal was made, right? Probabilities might have shifted. I was looking at a diplomatic stabilization, 0% now, missiles flying. So now we have a 50% containment, 35% sustained conflict, and a 50% major escalation. This is a full regional war. That means every other country has gotten pulled in. Looking at a note here for myself, right? We now have a high probability of volatility, right? But I gotta tell myself this is the exact environment where my fully cover called portfolio. Right, for those who have missed my video, I'm currently holding SPY, QQI, IWMI, GPX, GPIQ, and QDivil. This aims to outperform pure buy and hold by manufacturing the yield. How you play that yield and what you do after you get paid out is completely on you. Okay, this is where I say don't ever panic. Don't panic. Right, this is where we build generational wealth. All right, looking at how I want to have my barbell strategy. All right, so navigating an active war might require disciplined barbell strategy, right? So owning high conviction exposures while aggressively harvesting volatility. So looking at my income barbell strategy, that could print GPIX, GPIQ, IWMI, and QDivil. Right, looking at standard investors losing their shirts because of growth could really crash that time. Right, these cover call ETFs are designed to generate massive cash flow, right? During the exact market panic that could be happening right now. As soon as the market opens, all hell get loose. We don't know what's going to happen going forward, but I want to say do not panic sell. Do not panic sell, right? And this is why, again, I talk about it, building the fortress, right? I'm telling you right now, I am building up a cash position as fast as I can. My main builds are going to be SPY, QQI, and IWMI, unless other juicy deals does come along, like I mentioned, IDivil. Right, 4 reasons. Again, cash might be king. I know a lot of people told me cash is trash, but I do think cash is king, and it will always be king. Right, the active energy threat. I talked about this. Missiles are flying in the Middle East right now. Of course, severe scenarios project oil could spike. Inflationary trap, trade policy, and valuation collapse. If the valuation collapse on the S&P 500, this is where we're buying good deals, right? For those who owns closed-end funds, this is where we're buying, for the low. Of course, this is my best guess. Ultimately, I think 2026 could be a year where geopolitics overrides all valuations, where macroeconomics positioning and liquidity management could dictate outcomes for more than any individual stock selection. I think this year is going to be absolutely crazy. We're already like 2 months in, and we're about 3 months in now, right? 3 months in, and all this crazy stuff is already happening. So with 3 months in, I think it's going to just be pure geopolitical politics and straight volatility. Right? I hope you guys got something out of it. I know this was more of my guess and my rant. I hope it was kind of informative. I really wanted to make this video a little bit sooner, but then a lot of things happen. So hope you got something out of this. And for those who are new, don't panic. This is where we consider this a buying opportunity. So if you're new, give me a subscribe, comment, like. I hope you like my informative. If not informative, I hope you enjoyed my little rant. Thanks for watching. Stay tuned. Catch you guys on the next.